2025 has been a turbulent time in the markets, with headlines dominated by political uncertainty in the US. While what happens in the US might seem far removed from your pension pot, global markets are of course interconnected. And a shake-up in the US with the war on tariffs has rippled across global stock markets, including those that your pension might be invested in. The resulting volatility has created a concern for investors everywhere. Watching your hard-earned savings fluctuate is stressful, but it's especially worrying if you're retired, getting close to it, and relying on your investments to fund it. So in this video, we'll explore 8 ways that Vanguard suggests to keep your retirement on track during periods of market volatility. As we get to the end, some suggestions might seem a little less desirable, but still potential considerations to help keep your plan on track if it is not currently working out. So let's get on with Vanguard's first tip, which is to review your retirement goals. Certain studies suggest that people who retire genuinely need about 50 to 86% of their pre-retirement income to maintain that same standard of living during retirement that they had during their working life. Amongst the reasons for this lower retirement income could be that you are now mortgage-free and have no other debts, or getting close to being debt-free. The kids have left home and are no longer dependents, or you no longer have work-related expenses such as commuting. And because of these potentially big changes, now might be a good time to reassess your retirement income needs and to ask yourself what you want and what you need, as there might be a big difference. Create a personal budget by using a spreadsheet, or a piece of paper if you're old school, to estimate what your expenses will be in retirement. I believe that doing this is one of the most important foundations to provide you with an insight of what you'll need in retirement to help you maximise the chances of retirement success. Once you've worked out monthly expenditure, deduct all discretionary expenses to then give you an accurate assessment of what you need as a minimum. And discretionary expenses could be things such as travel, hobbies, or even TV subscriptions. One thing worth noting when doing your sums and considering your goals is that you're likely to pay less tax in retirement. You will still have that personal annual tax allowance, as when working, of £12,570, so you'll only pay tax on anything drawn above this amount, and those basic and higher rate tax bands will still apply. But you won't pay any national insurance contributions on your pension income, and if your pension is a defined benefit one, most are these days unless you work in the public sector and still have access to a final salary pension, you'll have more control over what you draw and when by controlling what tax band you're in to ensure that you're as tax efficient as possible. Additionally, 25% of all your pension withdrawals will be tax-free. This is unless that 25% was taken as part of your lump sum when you retired. You also no longer need to make those pension contributions which weighed heavily on your salary during your working life. So crunch the numbers. You might have more here than you first thought. The Pensions and Lifetime Savings Association publish guides on what income you might need in retirement as a single person or a couple to achieve basic, moderate and comfortable lifestyles. Moving on to the next Vanguard tip, which is to adopt a flexible spending strategy. Instead of withdrawing a fixed amount from your pension each year, you could consider a more flexible approach where you adjust the amount of your withdrawals depending on market performance. This generally means taking out more when markets are doing well and less when they're not. However, to do this successfully, you would need to set a predetermined range so you never draw too much or too little. For example, and for illustration purposes only, if your desired income is £25,000 each year, then you might decide that £27,000 is the maximum you will withdraw and £23,000 is the minimum. What you actually set as your maximum and minimum limit will depend on many factors, including your portfolio's average annual return expectations. Vanguard refers to this strategy as dynamic spending, and this is one of the many tools that can be used to tackle one of the biggest risks for those in or near retirement, and that is sequencing of return risk. Sequencing risk is the danger in the timing of investment returns that can negatively impact an investor's portfolio. During market lows, investors are forced to sell more units if they want to achieve that same income. If an investor experiences negative returns early on in retirement when withdrawing funds, their portfolio may shrink faster than expected as additional units are realised, leaving a smaller portfolio of assets to recover when markets rebound. Of course, you might be fortunate in that the opposite might happen, and that you get positive returns early on, making you less vulnerable to sequence risk if those market downturns happen later in retirement, with a then better overall chance to sustain a portfolio for longer periods. So dynamic spending will help you counteract this, but you also have other financial tools at your disposal, such as to diversify investments in the run-up to your retirement to reduce volatility. Pension providers often do this for you automatically as you reach that retirement age by increasing your exposure to safer assets such as bonds, whilst reducing the number of equities in your portfolio. Bonds are generally seen as being a more stable and safer asset than equities, so by creating a balance between the two, you can achieve less volatility, but still sustain some growth in your portfolio. Regardless of whether this is what you want to happen to your pension, it might be worth checking with your pension provider in any case to see what the default plan is for your investments as you approach retirement. And this video talks about bonds in more detail, so check it out later if you want to learn more. Another tool at your disposal is to consider taking out an annuity. An annuity is a financial product designed to provide a steady stream of income over time and is typically used in retirement. You would use your investments to purchase one of these from an insurance company. In return, the insurer promises to make regular payments to the buyer, either immediately or at a future date. Obviously, I don't know anything about your personal circumstances. You would have to crunch the numbers to see if the cost of an annuity and how much you get in return would be suitable for you. And the last defence to sequencing risk that we're going to mention here is to maintain a cash reserve. This will act as a cash buffer in buying you time in not having to withdraw from your investment in market downturns. And financial investors often suggest holding roughly 3 to 5 years of uncovered expenditure. That's the gap between guaranteed income, such as pensions and annuities, and your annual spending. Having a cash buffer not only preserves your investments, but can also give you peace of mind and the added financial flexibility to react quickly to short-term financial events. Moving on to Vanguard's next tip to keep your retirement on track, which stays with the theme of cash, and is to think about cash management. Rather than drawing a monthly income from your investments when markets are falling, another option is to place a year's worth of money into a low-risk money market fund and to withdraw your income from that. This will mean you don't have to risk losses on shares and bonds during uncertain periods. A money market fund gives you a place to hold, not necessarily grow your savings, but still aims to give you a slightly better variable return than you would get on interest in cash savings with a bank. I've also previously done a video on money market funds for you to check out if you want to know more. Moving on to tip number 4, which is to put your costs on a more sustainable footing. When markets are volatile, controlling discretionary spending could be one of the key factors in maintaining a healthy portfolio. Consider cutting back on TV subscriptions or that unused gym membership. Do you need all that data you were paying for with that mobile phone contract? Check each expense and consider whether you need it or whether you can get it cheaper. And make sure that you're also taking advantage of any concessionary fares that you could be getting on public transport. If you have outstanding debts, then consider paying them down. But in doing so, ask yourself the question of whether your cash would do better for you invested or in savings, rather than paying off debt, especially if low interest debt. And continue to work through Vanguard's tips, with number 5 being considering downsizing your home. Many people consider moving to a smaller home for the less maintenance and work as they get older in any case. But moving to a smaller property, or a property in a cheaper area, can also be financially beneficial as well for 2 reasons. By converting some of that equity from your home into cash, you can raise additional equity to fund your retirement. And if you reduce your running costs in a smaller home in a cheaper area, you may also be able to get by on smaller income. And the next tip is to lean on other sources of income. The longer you leave your pension untouched, the more time it will have to recover from a weak market. Just like having a cash buffer, consider whether you have any other investments or assets that can provide you with an income. Do you earn rental income or have cash savings? Are there items in your house that you could sell to raise money? Online marketplaces make it easier than ever to sell unwanted items at low prices. Do you still need 2 cars, or even 1? So potentially, there are several options that can help you buy time. You could even consider taking in a lodger. The final 2 tips from Vanguard are a bit more drastic, but still potentially worth considering if nothing else is working, with number 7 being delay your retirement. If you haven't retired yet and were thinking of doing so soon, you could consider some sort of delay. This might not seem particularly appealing, but keeping your pension investments intact will give them more time to recover from market dips. You'll also then have longer to keep contributing to your pension, benefit from tax relief, and if you're employed, receive those employer contributions. You may only need to delay things for 6 months or so this may not be as bad as it seems. And the last point, tip number 8, is to return to work, whether that be part-time, full-time, or on a freelance basis, just to help your pension savings stretch a bit further. If you're retired or plan to retire soon, market instability can be especially upsetting. You might be questioning whether your savings can stretch far enough, or even wondering whether you need to delay retirement or go back to work. These concerns are completely valid, but the most important thing is to avoid making knee-jerk decisions based on short-term market moves. Rather than reacting emotionally, take this opportunity to step back and review your retirement plan. Assess whether your financial goals remain achievable, notwithstanding the current financial backdrop. Continuing to contribute to your pension if possible is a smart move. Despite market dips, pensions are one of the most effective tax-efficient ways to save. Review your pension's investment strategy to ensure its alignment with your changing timeline and appetite for risk. This may mean reducing your exposure to riskier assets by increasing your allocation to bonds. And when it comes to retirement planning, although you can make a lot of decisions based on common sense, now might be the one time to seek financial advice. A suitably qualified professional can help clarify your options through methods such as cash flow modelling and ensure that any decisions you make are based on sound financial reasoning and not short-term fear, by helping you to understand how your financial future might look under different economic circumstances. If you have no idea of what income you might need in retirement, then this video will help provide you with a starting point. Thanks very much for watching.